I think the biggest fear on a lot of people's minds is, where are we going with inflation? Is the Fed behind the game? How are they going to react? Are they going to raise interest rates like Volcker did in the 70s, which is basically going to put a hard stop on a lot of equity appreciation? Or is it a multi-year transient inflation? So I think there's folks like Jeremy Siegel, who are who's the chair of economics at the Wharton School of Business. And he's actually a good macro thinker as well. And he sort of expects, I think, that we have about 25% inflation over a few years. I personally think the Fed should be raising rates. I think it's politically uncomfortable. Inflation's a huge problem because when you have inflation, you raise interest rates to stop it. So not only is inflation a tax on all of your income, it's like this secret tax. So, if you're earning a wage of $100,000 a year and inflation goes up by 8% in a year and you get a 3% wage, you've lost purchasing power. And that's happening across the board right now. It's actually going to start happening globally. And you run into society issues and all sorts of problems when that occurs. The way to stop that, the traditional way, some countries try to do it differently, but the way that actually works is you raise interest rates. And when you raise interest rates, you effectively lower the discount rate of the cash flows coming out of the businesses that you've invested in. So if you've got a company that's going to earn a whole ton of money in 10 years and your discount rate is 0, it's like you've got that money at the same price today. But if you increase that discount rate to 10%, and now you pull it back 10 years, it's worth a very small fraction of what it used to be worth. So that's the problem. If the Fed is truly late, and I think they're a bit late, and inflation continues, they're going to have to raise rates pretty aggressively to stop it. And when they raise rates, it's gonna send equity prices in all sorts of different directions, typically down. So that is the major concern, is how the Fed handles the inflation. And frankly, I think that when you drop trillions and trillions of dollars on a nation, it's like diluting the dollar. And there's some international folks here. I'm talking a little bit domestically here in the US, but we drop 8 trillion and we have quantitative easing for years and we have interest rates at 0. It's all dilutive. It's like issuing shares of stock. So, there's only a certain amount of goods to purchase. The prices are going to go up. And so inflation's here. We're going to see what the Fed does about it and how that affects the discount rates in most people's calculations, because what it causes is people to sell. It also offers alternative opportunities. So if interest rates go way up, bond prices totally collapse. And the money that was going to flow from the money market into the equity market might now find a place in the bond market. So then you get supply and demand economics working against you as well. So inflation's generally not very good. However, I want to caveat that with one statement here, is that equities are still the best place to be if you choose the right equities. So, and maybe a little real estate's okay as well, because really, if you have inflation, like, you don't want to be in bonds and you definitely don't want to be in cash, and you have to choose somewhere to put your capital. Some people like gold and hard assets like that. They tend not to produce anything. So maybe there's a way to hedge this with a very small sliver, but that tends to not be very good overall. But if you find a great business that's truly growing, if you find a business that has a 40% revenue growth and they're going to be cash flow positive, or they are cash flow positive, and they just have a huge market space, they're just going to keep growing right along with inflation. So, or if you find a company where they're able to pass on the increase in their own costs to their customers, that's going to be a good place to put money if you're trying to outperform during a time of inflation. So inflation's a big risk. The Fed is a big risk, but equities, although equities are going to get hurt, it's sort of it's the best. You have to think about things as opportunity cost of capital, and it's still the best place for your money.